All right, this article is coming from Fortune by way of finance, Yahoo Finance. Tesla's coming crash as seven analysts lower their price target. One predicts stock is heading to $28. So you have this gentleman by the name of Dan Trainer. He's the CEO and founder of New Constructs. Believes that using the most realistic projections for the likes of sales and earnings, Tesla's worth something like $28. Trainer is unswayed by the narrative that Tesla is not mainly a car company, um, but a tech juggernaut that will set the pace in self-driving vehicles and produce next-gen batteries its rivals will rely on. Put simply, he believes that the flood of new, mostly bargain price models issued by every big competitor will substantially lower Tesla's profitability going forward. So to prove this out, his $20 price target, he's using a discounted cash flow analysis. And he says that for Tesla to get there, Trainer reckons that it must grow sales at 28% compound rate through 2031 and achieve after-tax operating margins of 13%, 80% higher than Toyota's current level of 7%. Tesla also needs to keep capex growth at 1/3 of its current rate, despite the requirement of consistently building new factories to sustain that exploding output. Excuse me. So typically, when you have a company that's in higher growth mode, it's going to the valuation is going to be at a premium. And usually, when companies are growing, they have to invest a lot in their infrastructure, and that's what Tesla's doing. Now, this article is coming from Motley Fool. 2 reasons to buy Tesla stock before it skyrockets. And I'm of the agreement, primarily based on liquidity, easing, helicopter money, and we've seen that in during the pandemic of a couple of years ago, when the Feds flooded the markets with cheap dollars. Tesla ran off to new heights. And the same thing's going to happen later this year, early next year. The Fed's are going to stop raising rates because we're going to enter a recession, and then they're going to have to put on QE 19. That's a joke. So this article goes on to say Tesla's margins remain fantastic. You wouldn't think so, right? Because they cut their car prices, I think, 6 times in the last 6 to 12 months. One of the things that set Tesla apart from most other automakers is its margins, which tends to be high for the industry. In 2022, the company generated revenue of $81 billion compared to an operating income of $13.7 billion, a margin of 17%. For comparison, Tesla's large U.S. rivals like Ford and General Motors generally have margins in the single digits. So, Tesla is like Apple in that it's a cult, and people are going to pay for the cars. Price wars fears are overblown. Okay, this is a good argument. Some Wall Street analysts fear that Tesla could eventually lose its margin advantage because of a recent spat in price cuts. While the company actually raised U.S. prices in May, this follows price reduction of around 20% globally by the start of the year. Yeah, so going into earnings, Elon and Tesla said that they lowered prices to spark demand, and the margins got hit and stock sold off. And then what was funny, I think 1 or 2 days after their earnings, they raised prices on a couple of their models. EV represents just 10% of new car sales in 2022, and Goldman Sachs estimates that this number will soar to 61% by 2040. The other thing is whoever owns the supply chain owns the market, and in particular lithium. And Tesla just announced news that they are breaking ground on a lithium refinery in Texas. What's next for Tesla? Well, it is selling for a rich premium. Price to earnings multiple of 42. S&P average is at 24, so double. But again, that makes sense if Tesla's growth is going to continue to skyrocket. But this looks justified when considering that the EV market is still in the early stages. And I'm not even talking about the EV market. I'm talking about their battery pack business. people are underestimating how big that's going to be. It could supersede their car business. All right, so let's go to the Tesla stock, and we'll start with the monthly chart, and I mean, you can see prices are down from the highs of 400 to sub 200, so they're down more than 50%, right? Which is a buying opportunity, right? But where can you buy? Where can you get in? All right, let's go to the weekly chart, and guess back in February, prices nipped this resistance area at the 220 level. It was time to take some off the table, right? After this gargantuan increase in price from the daily buy zone at 105, right? It doubled. Then we had some consolidation, and then we had a breakout to the downside on earnings. And if you look at the this weekly candle, it's a hammer candle, so potentially a hammer formation being set up. We did have a gap up, but now price is pulling back. But yeah, let's go down to the, well, before we go down to the daily, price is really just hanging around this resistance support band at 165-ish. All right, this is the daily chart, and yeah, this was earnings when it gapped down, but it seems to be forming a bottom. However, you do have this gap fill that hasn't been filled yet, and I think if Tesla can get down to the 142 level, there are buyers waiting here to go long. So I wouldn't do anything with Tesla at the moment. You want to see what's going to happen in the broader markets as well. But I think you can nibble at Tesla if price can get down to the 142 level. And it would be a screaming buy if price can get back down to the lows of January. Thanks for watching. Subscribe. Please like the video.